Let's try a second problem. Here, I'm going to plug in just a bogus number. I'll just put 775 here. And so the numbers look a little bit different last problem. I don't know why they look they're similar in some ways, but anyway, our last year numbers look very similar. But anyway, so here's what last year we made 5, underwriting gain of 5. Our required capital is exactly the same, 250. Our return on capital is a little bit higher at 10%. Investment return is a little bit higher at 5%. Frequency is increasing 2, but severity 5%, maybe because of inflation, higher inflationary period, and that might be why our return on capital is higher. Our timing is a little bit shorter, so maybe this is mainly auto-physical. Frequency and severity growth and LAE, a little bit lower growth and severity. Again, you know, the severity here has to do with the increase in car parts and just the price of car entirely. This is more salaries of adjusters and legal people. And then growth in expenses is only 3%, so it's kind of a strange combination of assumptions. I don't know what I was thinking putting those together. So what are we going to do? Well, the first thing we do, we take last year's claims times 1 plus 2% times 1 plus 5%. So it's a little different than, you know, if you just take the 500 and multiply it by 1 plus 7%, you'll get a slightly lower number. See, 535.50 versus 535. So we're somewhat compounding the two against each other. So you do need to multiply by both. Same thing with LAE. You increase it by 2% and increase it by 4%. So 1 plus 0.02 times 1 plus 0.04. Make sure you have your parentheses in the right place. Expenses a lot easier. You just increase it by the growth. So that gives us an underwriting loss of 1670. And then what we do is we take the claims and divide it by 1.05, our investment return, raised to the 0.5. So you'll have it set up there. That's how you want to do it in your calculator. Same things with LAE. Same thing with expenses. Here you notice my N for all of them was 0.5. So investment earnings, see if you can, off the top of your head, remember. So first of all, it is the difference between the undiscounted and the discounted claims and expenses. And then we're going to add a 5% investment return on the beginning, the required capital. So if you take the sum of the undiscounted minus the sum of the discounted and add that earnings on the opening net worth requirement, you get the 3158. So hopefully that's making sense. So that gives you a net income. Your underwriting gain or loss plus your investment income gives you your net income. Your required capital is just 1/3. So you take the average required capital. The change in required capital is 833. So your net income is the 1488 minus the change in required capital. You then take that net income, again remember it's net income minus the change in required capital divided by average required capital. So the only thing really unusual about dividing by the average capital is not that unusual. Most firms do that even outside of financial services. It's this change in required capital, and even that might be unique to many companies. Not all companies do that, but really wanted to, I like this approach. We talked about this a lot when I was at USAA, is should we penalize financial services companies for doing business that actually increases their risk, makes them have to hold more net worth? Should we penalize that business? And I absolutely think we should, because that's capital that, yeah, it's there, it's in our net worth, but it's tied up in this line of business and can't be used for anything else. So, all right, so obviously, in this case, we have a firm that's making 2.58%. It needs to make 10%. So remember, this cell right over here takes the difference between the 10 and the 258 and then multiplies it by a big number. So what you need to do is go up to the premiums, and just the theory of what we're doing, we're trying to find a premium such that we want to, oops, hit the wrong button, So goal seek, you want to make this cell equal to 0 by changing your premium. And when you do that, it may take Bill Gates a few minutes to do it, but you got pretty close, 10%, 10%. And then again, what is this firm after? Well, what they'll actually file is not 80403 because they have thousands of policyholders, thousands of different types of accounts that they're insuring. And so what they're going to do is file the fact that they need next year's premiums divided by this year's premiums minus 1, or they need a 7.2% premium increase. In some states, you would just file 5% because you know the state's not going to approve anything more than 5%. If you file that 5% and then the next year you only need a 2% rise, you'll probably still file 5% and you'll somehow get the numbers to work out so 5% makes sense. Maybe bringing some of the losses from the last year. I don't know how the actuaries do all this. It's managing the regulators is a huge deal. So what do you do if you can't charge that much? What if the regulators only allow you to charge $790, or say a 5% increase? So you can only charge $787.50. That's all you can charge. That only gives you a 5.81% increase, but at least the regulators are happy because your rates only went up 5%. So what can you do? Well, you can cut expenses some. So let's say you can cut your expenses 5%. That helps some. What can you do for claims and LAE? There's not much you can do. You got a contract there. So you might try to essentially get your worst customers. We talked about this with USAA, State Farm, Allstate. There are some customers, a small fraction of the customers, 4 or 5% of the customers, who account for the bulk of the risk, especially in homeowners. Maybe you cut back. So for claims and LAE, you cut back on bad customers, customers with high frequency and severity. We talked about that with credit scores. If you find some new way to underwrite, obviously you have to prove that with the states. But if you can find some way to do that, then that might be, you know, some mechanism that you can better underwrite this business. But if you can somehow get rid of your worst customers, you don't renew them. So you know that's a possibility. Cutting expenses is something you always want to do if you can, but it's not always an option, or you should be doing it all the way anyway. So there's not much more you can do. The investment earnings, maybe you could make more than 5%. Maybe get your firm to make 5.5%. But remember, if you increase investment return, then you're increasing risk. You can't tell your investment managers, most of this, you know, it's bonds mostly. There are some stocks. We'll talk about that a little bit later. But you can't go to a bond portfolio manager and say, hey, we need to make 5.5% instead of 5%, and have them do that without taking on more risk. And probably the best you can get out of them is an extra 0.1%. So you're still well below. What else can you do? Well, you could reduce your capital requirement. So instead of doing 3-to-1, do 3.5-to-1. That gets you closer. So reduce your capital requirement. But what is that going to do? But that just, you might lose your ratings. They might downgrade you. Maybe you were single A and now they're going to make you triple B. So you can't just say, hey, we're going to hold less capital so get a higher return on equity. But that might be another solution. But you don't have many options. Ultimately, you're just, you know, you're just gonna have to not make that return that year and hope you make it up in the future years. If your rate is too high, if you charge too much, let's say you charge $920, that's great. Or well, let's not get quite so extreme, but $870, let's say. So now you're making a 30. Well, that'd be great, but you're going to be uncompetitive and the regulators will not approve it. So you that are at actuarial majors and you want to get into this business of pricing actuaries, I think are really interesting. Let me get my numbers back to normal. So here we're back to the original. This is what you know you need, and then you've got to work with CFO and underwriters and everybody else to try to get this product to work. So if you're a pricing actuary, you're right in the middle of this major product line for a business, and your goal is to get this product to work given the constraints that you have. I think it's a wonderful math problem. There's a lot of moving parts. There's a lot of things you can look at. You can work closely with the underwriters to try to figure out how to get this business better. But I think it's a fun process. So what we want to do now is I'm going to give you about 15 minutes. So I'm going to count 15 minutes of class time to work this problem. So you can freeze the screen so you can see the numbers. This is how I'll give the problem on the exam. No telling again how I'm going to do it in the final exam. But here's their premium for the current year, their claims, their losses, the underwriting expenses, their underwriting gain, the required capital. I'm using the 1/3 just like before. Here's the growth in frequency and severity, and use an N of 0.5. Claims exactly the same. LAE exactly, well, LAE I did make a slightly different, but the timing, the 0.5 is the same. So you use 3% and 3.5% for claims, 3% and 2% for LAE. Use 0.5 for both. The underwriting expenses 2.5%, and you use 0.5 on that. The investment return is 4%, and then 7% return on capital. Remember, our return we're reducing for the change in required capital. I gave you two premiums. Well, what I would encourage you to do, so I'll count 15 minutes for this. So you'll work this problem, and I'll come back. The last session will be pretty short. I'll just walk you through. And what I want you to do is building in Excel with a blank Excel spreadsheet. So have these numbers down and do what we did here in Excel, but without all this built for you. Don't use this template. If you want, if you have this file loaded, maybe add a sheet and do everything from scratch, and then if you need to look back and see how you did it. But see if you can build this whole thing, and then I'll come in with the last part of this class and show you the answers. So again, there's your problem. Freeze the screen, maybe do a snip and print it out so you can see it. You see that it's going to be one of these two premiums is going to be the right answers, so that might help you as well. So all right, so we'll stop it there, and I'll give you 15 minutes. So we'll count that as part of this class exercise.